Imagine walking to your mailbox every single month and finding a check waiting for you. A check powered by Warren Buffett's legendary investment wisdom. Not just any check. We're talking about potentially collecting a 15% annual yield paid out monthly. Today, I'm diving into what might be the most interesting ETF launch of the year. An investment that lets you tap into Warren Buffett's genius while collecting monthly income that JEPI and JEPQ investors can only dream about. The Vista Shares Target 15 Berkshire Select Income ETF, ticker symbol OMAH, is flying under the radar right now, but not for long. By the end of this video, you'll know exactly whether this Buffett-inspired monthly dividend machine deserves a place in your portfolio or if you're better off sticking with more established options. I promise to give you the complete story, both the exciting potential and the hidden drawbacks that other videos might gloss over. If you're serious about generating passive income and want the inside scoop on investments like this, make sure to hit that like button and subscribe to our channel, and ring the notification bell so you never miss out on these wealth-building opportunities. When we talk about Warren Buffett, we're talking about arguably the greatest investor of all time. For decades, investors have tried to replicate his success by buying shares of his company, Berkshire Hathaway, ticker symbol BRKB. There's just one problem: Berkshire doesn't pay dividends. Buffett prefers to reinvest profits back into his businesses, which has worked phenomenally well for long-term growth. But what if you could access Buffett's investment genius while still generating monthly income? That's exactly what OMAH tries to accomplish. It's not simply investing in Berkshire Hathaway. It's taking Warren Buffett's best holdings and engineering them specifically for maximum monthly income. OMAH gives you exposure to the same blue-chip companies that Buffett himself handpicked, but with a twist. It uses option strategies to convert those investments into a monthly income stream. Let me break down the three pillars that make OMAH unique in the ETF landscape. First, it seeks high monthly income generation, targeting an impressive 15% annual income distributed monthly. Instead of waiting for quarterly or annual dividends, you're getting consistent monthly payments that can help cover expenses or be reinvested to compound your wealth. Second, OMAH provides core equity exposure by investing in a diversified portfolio of large and mid-cap companies, essentially giving you access to some of the most stable and profitable businesses in America. And third, you benefit from professional options management. The fund employs a data-driven options investment strategy managed by experienced professionals who handle all the complex options trades that most retail investors would struggle to implement effectively on their own. It's like having Warren Buffett's stock picks with an income-generating engine attached to them. So who exactly is this ETF designed for? If you're approaching retirement or already retired and looking for consistent monthly income to supplement your lifestyle, OMAH might be extremely attractive to you. The potential 15% annual yield means that a $100,000 investment could generate around $1,250 in monthly income, significantly higher than what you'd get from traditional dividend stocks or even other popular income ETFs. If you're a portfolio diversifier who already has growth-oriented investments but wants to add an income component without sacrificing quality, OMAH gives you access to blue-chip companies while still generating cash flow. And if you're a Buffett admirer who loves his investment philosophy but wishes Berkshire paid dividends, this ETF might feel like the perfect middle ground. However, and this is crucial, OMAH should not be the only ETF in your portfolio. Despite giving you exposure to Warren Buffett's top holdings, it's still relatively concentrated compared to broad market ETFs. It holds approximately 20 stocks, which doesn't provide the same level of diversification as ETFs tracking the S&P 500 or total market indexes with hundreds or thousands of companies. For proper diversification, you should consider pairing OMAH with other quality funds that give you exposure to different sectors, market caps, and even international markets. Remember, even Warren Buffett himself recommends index funds for most investors. Now, let's talk about the trade-offs, because as we all know, there's no free lunch on Wall Street. When you're getting a high yield like 15%, something has to give. And in this case, it's your upside potential. The covered call strategy that OMAH employs limits how much you can benefit from significant price appreciation in the underlying stocks. Here's a concrete example. If Apple stock, one of the largest holdings, suddenly jumps 20% after an amazing product announcement, traditional shareholders would enjoy that full 20% gain. But as an OMAH investor, your upside might be capped at, say, 5% because of the covered calls that have been sold. You're essentially trading future growth potential for immediate income. This means that in strongly bullish markets, OMAH will likely underperform Berkshire Hathaway stock and even the broader market. The tax implications are another consideration that many investors overlook. The income generated from covered call ETFs like OMAH is generally classified as ordinary income rather than qualified dividends. This means instead of paying the lower qualified dividend tax rate, which tops out at 20% for most investors, you might be paying your ordinary income tax rate, which could be as high as 37% depending on your tax bracket. For someone in the 24% tax bracket, a $10,000 annual yield from OMAH might result in only $7,600 after taxes, compared to around $8,500 if it were qualified dividends. This tax inefficiency makes OMAH and similar covered call ETFs better suited for tax-advantaged accounts like IRAs or 401ks. There's also the matter of the expense ratio, which at 0.95% is substantially higher than many other ETFs. This means that for every $10,000 invested, you're paying $95 annually in fees. Compare that to JEPI's 0.35% expense ratio, $35 per $10,000, or a typical S&P 500 index fund at around 0.03%, $3 per $10,000. These fees might seem small, but they compound over time and eat into your returns. The question you need to ask yourself is whether the active management and option strategy justify the nearly 1% expense ratio. Now let's put everything together in what I call the ultimate ETF showdown. OMAH versus JEPI versus JEPQ versus BRKB. When it comes to diversification, JEPI and JEPQ win hands down. They provide exposure to many more companies across various sectors, with JEPI tracking the S&P 500 and JEPQ focusing on the NASDAQ 100. OMAH, with its approximately 20 holdings, is much more concentrated, though still more diversified than owning individual stocks. For dividend yield, OMAH takes the crown with its targeted 15% annual yield, significantly higher than JEPI's roughly 7 to 9% and JEPQ's 8 to 11%. Berkshire Hathaway pays no dividend at all, so it scores 0 in this category. Looking at dividend stability, we have to give an edge to JEPI and JEPQ based on their track record, though admittedly OMAH is too new to have established a pattern. Other similar covered call ETFs have shown that maintaining consistent monthly payments can be challenging in volatile markets. The expense ratio comparison clearly favors Berkshire Hathaway, which has no expense ratio since it's a stock, and the JP Morgan ETFs, JEPI and JEPQ at 0.35%, over OMAH's hefty 0.95%. For total returns potential, especially in bull markets, Berkshire Hathaway would likely outperform all the covered call ETFs due to its uncapped upside potential. And finally, from a tax efficiency standpoint, Berkshire Hathaway wins again because it generates no taxable events until you sell, while all the covered call ETFs create regular taxable distributions. So what's my verdict? OMAH represents an interesting innovation in the ETF space, essentially creating a dividend version of Warren Buffett's investment strategy. For income-focused investors who value monthly cash flow over long-term growth potential, it offers an intriguing option. However, I believe most investors should approach OMAH with caution for several reasons. First, it's a very new fund with limited track record and liquidity. Second, the 0.95% expense ratio is quite high, especially when you consider that you could own Berkshire Hathaway directly with no ongoing fees. Third, the tax implications make it less than ideal for taxable accounts. If you're still interested in OMAH after considering these drawbacks, here's my suggested approach. Start small, perhaps allocating no more than 5% of your portfolio to test the waters. Monitor the consistency of the monthly distributions to see if the fund can actually deliver on its 15% yield target. Compare its actual performance against BRKB, JEPI, and the broader market over at least 3 to 6 months. And most importantly, consider holding it in a tax-advantaged account like an IRA to minimize the tax hit from those unqualified dividends. In conclusion, Warren Buffett's investing philosophy has created tremendous wealth for Berkshire Hathaway shareholders over decades, and the idea of tapping into that wisdom while generating monthly income is undeniably appealing. OMAH offers a creative solution to the Buffett doesn't pay dividends problem, but it comes with significant trade-offs in terms of expenses, tax efficiency, and growth potential. For most investors, a balanced approach might be best, perhaps owning some Berkshire Hathaway for long-term growth and using other established income ETFs like JEPI for current cash flow needs. But if the idea of receiving monthly dividends from Warren Buffett's top holdings sounds irresistible, OMAH could be worth a small position in your diversified portfolio. Just remember to do your own research and consider how it fits into your overall financial plan and tax situation. How would a monthly 15% yield change your financial future? Let me know in the comments below. And don't forget to like and subscribe for more investing insights. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.